Good evening. My name is Jonathan, and I will be talking about sensitivity analysis as a tool for capital budgeting. What is sensitivity analysis? Sensitivity analysis is a crucial tool in capital budgeting that helps businesses evaluate how changes in key variables affect the profitability and risk of investment. It allows decision making through different scenarios projected by forecasting and analyzing how different scenarios impact financial outcome. Going on to talk about definition, variables, qualitative versus quantitative, risk of investment, and decision making of capital budgeting. How sensitivity analysis works in capital budgeting: businesses evaluate projects by using financial metrics such as net present value, internal rate of return, payback period, and profitability index. Sensitivity analysis measures how sensitive these metrics are to changes in key assumptions such as sales volume, cost of capital or discount rate, raw materials cost, operating expenses, and inflation rates. By adjusting one variable at a time while keeping others constant, managers can assess which assumptions have the greatest impact on project viability. By using different scenarios, you can alter different assumptions about decision drivers such as discount rate and cost of capital to project different outcomes to help investors make sound decisions when it comes to their business ventures and help outcomes such as profitability and losses. Different input variables help make decision making, helps determine which variables significantly impact project profitabilities, allows managers to focus on mitigating high risk factors. It improves decision making. If a project remains profitable under different scenarios, it is considered more financially stable. It helps compare multiple projects under different market conditions. It also enhances strategic planning. Companies can prepare contingency plans if costs or revenue fluctuate. It also helps business develop risk adjustment return expectations. It supports investment justifications, provides data-driven approach to convincing investors or stakeholders. Shows best, worst, and most likely scenario for capital investments, which I'll talk about later. But a couple of those assumptions that adjust are revenue growth, cost of goods, discounted rates, equity, and that helps drive operating margins, debt levels, cost of goods, revenue growth, and weighted average cost of capital. For example, using sensitivity analysis, a company can test different scenarios. If the sales drops by 20%, the net present value decreases. If the cost increased by 15%, the interest return rate drops as well. If the discount rate rises to 12%, the project's net present value becomes negative, making it less attractive. By testing different assumptions, companies can ensure they invest in projects that remain viable under various market conditions. Qualitative versus quantitative. Qualitatives have a couple of steps when it comes to defining objectives, identifying key variables, and set base case assumptions, while quantitative steps adjust variables one at a time, perform scenario analysis, and interpret results for decision making. The qualitative part, as you can see on the left side, the Excel sheet has projected numbers considering the profits of last year's report or the current cost of goods / advertising, using effective numbers to make a Excel sheet of projected and forecasted numbers. This helps investors and shareholders on their input when it comes to investing and agreeing with decisions the business is making for the good of the company. The qualitative is a more strategic focus and risk identification by using numbers and projections to analyze how a company might spend while quantitative uses the credible numbers already in the qualitative by making adjustments, modifying each key variable individually while keeping all others constant, determining how changes affect outcomes like payback period, net present value, internal rate of return, and profitability. The payback period for a business is how long a business is willing to wait to recoup on its investments. Some businesses have a payback period of 5 years, while others have 1 year in order to break even. Once break even, everything else is profit. Net present value, for example, if the sales volume increases by 10%, the net profit value, present value rises. The more positive, the more acceptable the decision will be on a product. An internal rate of return, if the accepted project has a better rate of return greater to or equal to the cost of capital, it helps make the decision better for shareholders and investors. So profitability depends on payback, net present value, and internal rate of return are definitely indicators of business care and decision making. As you can see, the Excel sheet, the cash flow statements, benefit and cost summarizes the relevant business case inputs to help make the quantitative decisions of scenarios. The risk of investments. Sensitivity analysis is a powerful risk assessment tool. Helps businesses understand financial risks, prepare for the uncertainties, make more informed investment decisions. What that means is by using mathematical modeling and scenario testing helps make a well-formed decision for those investors and shareholders. Decision making for capital budgeting. Sensitivity analysis is a crucial tool for capital budgeting that helps businesses evaluate how changes in key variables affect the profitability of risk assessment. Allows decision makers to test scenarios to project numerous outcomes by changing variables to determine different outcomes, ensuring stability for future endeavors, and as well prepare for worst case scenarios if shortfalls do occur. This helps convince investors and shareholders with these scenarios and data put together. For example, for a best case scenario, the higher the sale, the lower the cost. Worst case scenario, lower sales, higher costs, and that happy middle is a realistic expectation on current markets. That means that happy middle is regardless of what you're doing, you will always profit. It might not be exponentially, but it's still profit. Thank you.